What if I told you that keeping all your money in a savings account is actually making you poorer every single day? I know that sounds crazy because we've been taught that saving is smart and investing is risky. But here's the harsh reality. If your money is sitting in a bank earning 1% while inflation runs at 3 to 6%, you're losing 2 to 5% of your purchasing power every single year. By the end of this video, you'll know exactly how to start investing, even if you've never done it before, even if you only have $100 to start with. No jargon, no complexity, just a clear step-by-step roadmap. Let's dive in. Let me show you something that changed my entire perspective on money. If you put $10,000 in a savings account earning 1% interest for 20 years, you'd have about $12,200. Not bad, right? But here's the problem. With inflation averaging 3%, that $12,200 only has the purchasing power of about $7,400 in today's dollars. You actually lost $2,600 by saving safely. Now, what if you invested that same $10,000 in a basic stock market index fund? Historically, the stock market returns about 8% annually. After 20 years, you'd have over $46,000. That's not luck. That's not genius-level investing. That's just understanding one fundamental truth. Your money needs to grow faster than inflation, or you're going backwards. The good news? You don't need to be rich to start. You don't need to be a finance expert. You just need to understand 5 simple steps. Before you invest a single dollar, you need an emergency fund. This is money you can access immediately for unexpected expenses, car repairs, medical bills, job loss. This stays in your savings account because you might need it at any moment. Here's the rule. Save 3 to 6 months of essential expenses. If your rent, food, and bills cost $2,000 per month, aim for $6,000 to $12,000 in your emergency fund. Why? Because the stock market goes up and down in the short term. If you invest all your money and then need cash during a market dip, you might have to sell at a loss. Your emergency fund protects you from that. Once this safety net is in place, everything else can be invested for growth. And here's a pro tip. Keep this emergency fund in a high-yield savings account that actually pays decent interest. Some online banks offer 4 to 5% right now, which is way better than the 0.5% at traditional banks. Now let's talk about where to actually put your money. I'll keep this simple. For beginners, there are 3 main options. Option 1, index funds. These are baskets of stocks that track the entire market, like the S&P 500, which includes 500 of America's largest companies. When you buy an index fund, you own a tiny piece of Apple, Microsoft, Amazon, and hundreds of other businesses. The beauty? They're diversified, low cost, and historically return 8 to 10% annually over the long term. This is where I recommend most beginners start. Option 2, target date retirement funds. These are even simpler. You pick a fund based on when you plan to retire, like 2050 or 2060. The fund automatically adjusts from aggressive to conservative as you get closer to retirement. Set it and forget it. Option 3, individual stocks. This is where you pick specific companies to invest in. It's higher risk and requires more research. I don't recommend this for complete beginners. Start with index funds first, learn the market, then experiment with individual stocks if you want. Here's what I did. I started with 80% in index funds and 20% in a target date fund. After a year of learning, I allocated 10% to individual stocks I believed in. Start simple, then expand. Step 3. Choose the right account. On screen, account types comparison. You can't just buy stocks directly. You need an investment account. Here are your best options. 401k. Through your employer. If your employer offers a 401k with matching contributions, this is your #1 priority. That matches free money. If your company matches 50% up to 6% of your salary, that's an instant 50% return on your investment. You literally cannot beat that anywhere else. Contribute at least enough to get the full match, then consider other accounts. 2. Roth IRA, Individual Retirement Account. This is a personal retirement account where you invest after-tax money, and then all your gains grow completely tax-free. In 2024, you can contribute up to $7,000 per year if you're under 50. The Roth IRA is incredible for long-term wealth building because when you withdraw in retirement, you pay zero taxes on decades of growth. 3. Regular brokerage account. This is a standard taxable investment account with no contribution limits and no restrictions on withdrawals. Great for goals that aren't retirement, like buying a house in 10 years or building generational wealth. Where to open these accounts? I recommend platforms like Fidelity, Vanguard, or Charles Schwab. They're reputable, have low fees, and offer excellent index funds. You can open an account in about 10 minutes online. Step 4. Start with dollar cost averaging. On-screen, DCA graph visualization. Here's the biggest mistake beginners make. They wait for the perfect time to invest. They think, I'll wait until the market dips. Here's the problem. You can't time the market. Even professional investors get it wrong. Instead, use dollar cost averaging. This means investing a fixed amount regularly, like $200 every month, regardless of whether the market is up or down. When prices are high, your $200 buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your cost and removes emotion from investing. Here's what this looks like in practice. Set up automatic investments from your checking account to your investment account. Every month, on payday, $200 or whatever amount works for you automatically invests in your chosen index fund. You don't think about it, you don't stress about market timing, you just consistently build wealth. I started with just $150 per month 3 years ago. Now I'm investing $800 per month, and my portfolio has grown to over $35,000. It works. Step 5. Stay the course and keep learning. The final step is the hardest. Patience. The stock market will go down, sometimes by 20%, 30%, even 50% during major crashes. Your portfolio will show red numbers. This is normal. Every single successful investor has lived through market crashes. The key is, don't panic and sell. If you're investing for 20, 30, or 40 years, short-term drops don't matter. In fact, they're buying opportunities. Warren Buffett, one of the greatest investors ever, once said, "The stock market is a device for transferring money from the impatient to the patient." Your action plan starting today. Calculate your emergency fund goal and start building it. Open a Roth IRA or 401k. Choose one low-cost index fund to start. Set up automatic monthly investments. Don't check your portfolio every day. Check quarterly. Here's the truth. Investing isn't about getting rich quick. It's about building wealth steadily over decades. The earlier you start, the more time your money has to grow. You don't need to be an expert. You don't need thousands of dollars. You just need to start. If you found this helpful, drop a comment below telling me how much you're planning to invest per month. And subscribe for more no BS money advice. Let's build wealth together.